Today, I'm going to talk about something that every trader has experienced on their charts, and I'm sure many of them have got tempted to trade that aspect. I think you guessed it. I'm going to talk about price gaps. I've been with the Indian equity markets for over 21 years now, and price gaps is one aspect which has extreme fear associated with it. But on the other hand, a successful price gap up or gap down can lead to supernormal profits. So, allow me as I walk you through my thoughts about price gaps. Hello again. Welcome to this playlist, which we have named Beyond Charts. In Beyond Charts, we're going to talk about those aspects about trading, investment, markets, which are not directly related to the price chart per se, somewhat more psychological. And in today's Beyond Charts, we're going to talk about price gaps. If you're completely unaware about price gaps and you want to know more about price gaps, there's been a video that I uploaded many years back. There are essentially four types of gaps, and I would request you to go through that particular video. The link of that video I've shared in the description box below. Now, you wake up in the morning, you check the news, and you figure out that the markets are going to gap up or gap down. Let's say, for example, gap up. Now, why is it going to gap up? These gap ups are essentially a direct function, an emotional outburst of some positive aspect that had must have happened overnight, either global positive cues or particularly related to the stock that you're tracking or analyzing. Maybe its earnings have come out much better than anticipated, what the street expected, or any form of positive cue which leads to this gap up. So, essentially, at its core, it's an emotional outburst which makes the market bid a much higher price. Who's planning to buy or ask those who are planning to sell will quote a higher price at the very beginning of the day to sell their quantity. So, to begin this discussion with, we need to understand that a gap up or a gap down is essentially an emotional outburst. So you understand that a gap is created not essentially out of logic, it's mainly created out of emotion. It can be a positive emotion, that's why a gap up, or the emotions can be on the negative side and you may have gap down. Now, I've created this content for you in the month of June 2026 amidst uh, the US Israel Iran war that we've been going for quite some time now. Positive tweets or messages from either of the party leads to a gap up next day morning or an opposite gap down. And we are going through this choppiness, this volatility as I create this video for you. But one thing both of us understand at this phase that gaps are essentially, as I mentioned some time back, is an emotional outburst and there's very little logic to it at that particular time. Now, for a trader, he will feel a bit of FOMO. He will feel that should I jump the gap? Should I go for it? Now that the ceasefire has called, the market will probably bottom out and that's the end of the war. Let's buy. Now, that's the decision making that needs to be done, and it's not easy at all. I'll share my thoughts how I look into these gaps. Now comes a very important question at this juncture that should we be at all trading a gap up? And my immediate answer is a no. Mainly because, of course, it's an emotional outburst and I've spoken about it. But because of this gap up, firstly, your risk reward ratio goes for a toss. Your stop loss, which we probably had thought of earlier the previous day, now all of a sudden, because you land up purchasing it at a much higher price, you land up looking at a much lower, wider stop loss, means in percentage terms, a much wider risk. And that will require you a much higher upsides to make a meaningful risk reward ratio. So that's one. Second is also, what kind of a gap is it? So, as I shared with you earlier, there are four types of gap: pattern gap, breakaway gap, runaway gap, and exhaustion gap. I'm not going to cover this in this particular video, but out of these four gaps, two of them are interesting: the breakaway gap, that's the second one, and the fourth one, which is an exhaustion gap. A breakaway gap essentially forms when it's breaking out of a pattern. Let's say cup and handle, symmetrical triangle, head and shoulders. So, whenever there is some kind of a pattern and prices are breaking out of it, it tends to, not always, tends to take the shape of a gap up and breaks away from that pattern. Most of the time, volumes are very, very high at this juncture. Now, when it is breaking away from the pattern, and probably you have noticed that pattern, you have seen and observed that pattern, you're waiting for the breakout from the pattern, and now, today morning, the breakout is going to happen with a gap up. You would have wished that, why did it move with a gap up? I would have got an entry. Now I will land up buying it, purchasing it at a relatively higher price. So, breakaway gaps can still be traded provided they are not very, very wide. Gaps can still be traded if your thought process and your objective is from an intraday point of view, that the market's mood has turned positive and it has gapped up. I will wait for a pullback and then try and do a pullback trade, and when it bounces back, I'll make use of that intraday move. But when you're talking from a positional point of view, these two gaps, the breakaway gap and the exhaustion gap, can still be thought of provided it is not very, very wide. So, my answer of no is, when you're looking at a gap up today morning, the best thing is to just sit back and observe that how much does it gaps up. If it's a very, very wide gap, your risk reward ratio is going for a toss. You wait. If you're an intraday player, you wait for the pullback and then look for a better opportunity. And if it's breaking away from a pattern and the breakaway gap is not very wide, it still makes sense. But I will always and always suggest wait out a little bit. There is a technique which I'll share with you in some time. But before that, I'll talk to you about exhaustion gap. Now, exhaustion gaps are the most intriguing, interesting ones, because that's where the trend is at its peak and extreme and at its best. That's the top. And that's the last bout of buying before the chart, before the market tops out. You will tend to see that it gaps up, but it fails miserably and it slips. That's the gap, that's the exuberance that is used by the market to reduce their positions. Again, in this case, even if you plan to trade a gap up, you should wait. In this case, the trade is essentially on the opposite direction because you see exhaustion there. In terms of Japanese candlestick patterns, this is where you will get abundant baby top, evening star, morning star, those kind of patterns. A breakaway gap can be taken in the direction of the gap. An exhaustion gap gives a sign, a signal, a reading against, opposite the direction of the chart. So the exhaustion gap exhausts the chart and can reverse. Breakaway gap is the fresh bout of momentum that can lead to the run up. Now, having said all of these things, I will stick to my answer of no. Don't create FOMO. Don't lose your logic. Don't skew your risk reward ratio and unnecessarily jump into a trade just because everyone's jumping into it. So I'll stick to that. I did share with you earlier that there's a technique that I would like to share. And the technique is, you can always play with your quantity. You can always pyramid. For example, you had thought of taking a trade, let's say 100 quantity. Now, for whatever reason, it's going to gap up tomorrow morning. You thought you'll buy at an X price, but you'll end up buying it 2% higher because of the gap up. Now, because you are buying 2% higher, whatever quantity you had thought at a previous price, which was 2% lower, what I would suggest is just reduce the quantity so that your net risk to that trade remains the same. Even with a wider stop loss, your absolute risk remains constant. So, this is one thing that you can do. The second thing that you can do is I was prepared to take the trade. The chart is going to break out, but the breakout is coming with a big gap up. I will land up buying at a much higher price. So, let's do one thing, let's buy 50% first. Let's buy 50% first and let's observe. There's no rush. Let's see whether the gap sustains or not, whether there's a gap failure or not, whether the gaps get filled or not. There's no rush whatsoever. It's the rush, the haste, the FOMO that creates the problem in the trader's mind. Do let me know if you agree with this. So there's always a way around. But the first thing I would say is if you see a gap up or a gap down and you are planning to take a trade, the best thing is wait out. No, I'm not going to trade the very first trade in the morning. Let's wait out. Let's see how it plays out and then position yourself. Please share your thoughts about gaps and how you deal with them. Till then, take care of yourselves. Trade well.